There is a palpable nervousness on Dalal Street.
All sectors are in red.
94.5 lakh crore rupees of investor wealth has been wiped out.
The Indian stock market has just tipped over. The Nifty 500 is down 15%, Nifty midcap 100 by 17%, and Nifty smallcap 100 is down by 20%. But for many retail investors, this is completely new. A portfolio that's all in red. Trend lines all pointing downwards. Even that almighty untouchable stock you picked is now probably looking bleak. Thing is, an abnormally long bull run meant millions of new investors dived right in, but now that the market is correcting itself, millions are trying to cash out. Suddenly, fear and panic seem to be driving the narrative here. But how? Our markets went from sky-high investor confidence to a panic-driven sell-off in just a few months. Which is why today, we're going to dive deep into the current market drawdown and help you understand why markets fall in the first place, and also what you can do about it. The world goes through seasons. As you already know, summer gives way to monsoons and dry heat suddenly changes to torrential rain. The stock market works in a very similar way to this natural order. The market doesn't simply march upward in a straight line. It breathes. It expands and contracts. Right now, many investors are experiencing what contraction feels like for the very first time. We highlighted these new entrants in our last video. We showed you how, post-COVID, a multitude of factors resulted in the number of retail investors increasing exponentially. And most of these new investors are young and inexperienced, which means they really haven't seen their portfolios bleed like it's doing right now. However, when the seasons change, people generally don't panic, right? But the second a bear market seems imminent, just in January 2025, SIPs saw their stoppage ratio soar to approximately 109%, meaning more SIPs were discontinued than newly registered. Investors are panicking, almost as if this correction was somehow unexpected, whereas the experienced investors were probably waiting for the market to correct itself. You see, the ability of the market to fall isn't a bug, but a feature of the market. In fact, it's necessary for the market to fall, and that's why it's called a market correction in the first place. But let's address the elephant in the room. Why do markets fall at all? If India is the fastest growing major economy in the world, shouldn't our markets just keep going up? The simplest answer is this. Markets fall because, well, there are more sellers than buyers. I know, that sounds obvious, but stick with me here. The stock market isn't some mystical entity that moves on its own. It's simply the collective actions of millions of people making decisions every day. And when more people want to sell than buy, prices drop. But why does this happen in cycles? Two reasons. First, economies naturally cycle between growth and contraction. Businesses expand, then hit capacity limits. They overproduce, then need to scale back. Interest rates rise and then fall. Second, and this is crucial, human psychology tends to swing between greed and fear. During bull markets, investors get increasingly comfortable taking risks. Valuations climb higher than what's reasonable. But then eventually, someone blinks. Maybe it's a bad earnings report, maybe it's a global crisis, and suddenly, everyone rushes for the exits at once. The legendary investor Howard Marks put it best. The only certainty in the market is uncertainty. You can have opinions, but you should never be certain you're right. This is why markets don't just grow steadily. They move in cycles. And right now, we're experiencing the downward part of that cycle. So let's break down the 5 main factors driving our current market correction. Reason 1. Indian markets became extremely expensive. For the past few years, Indian stocks have been trading at some of the highest valuations in the world. By late 2024, the Nifty 500 CAPE ratio hit 40, far above its long-term average. Professor Ashwath Damodaran called India the most expensive market in the world, with companies trading at 31 times earnings, 3 times revenue, and 20 times EBITDA. When valuations get this stretched, even good news isn't enough to push prices higher. The market needs to reset. Reason 2. Foreign investors started selling after the pandemic. foreign institutional investors fell madly in love with the India growth story, pumping in rupees 2.44 lakh crores. But since September 2024, they've sold over rupees 1 lakh crore worth of Indian equities. Yes, domestic institutional investors have bought rupees 3.4 lakh crore during this period, but that's not enough to offset the impact of this selling pressure. Reason 3. Corporate earnings have weakened. Over the last few quarters, the earnings growth of listed companies has dramatically slowed. Revenue and profit growth have both declined across most sectors. When stocks are priced for perfection but deliver merely good results, well, good suddenly isn't good enough anymore. Reason 4. Economic headwinds. India's GDP growth has moderated. Inflation has hurt household spending. Urban consumption has dropped significantly, and even the government has reduced its spending. With consumers not consuming and companies not investing, investors are increasingly questioning if the India growth story might need a rewrite, or at least an edit. Reason 5. Global uncertainty. Since 2020, we've had a pandemic, Russia's invasion of Ukraine, conflicts across the Middle East, and now political uncertainty in major economies. With this much global instability, investors naturally become more risk-averse, pulling money from emerging markets like India first. But here's the truth. While all these reasons sound logical and neat, markets are messy. Millions of people are making decisions based on their own fears, goals, and information. And trying to reduce all that complexity to a few bullet points is like trying to explain why it rained yesterday. What matters is how we respond, which is why even though things look bad right now, let's zoom out a bit. Here's a drawdown chart of Nifty 500, Nifty midcap 100, and Nifty smallcap 100. Look at the dotted lines at the bottom of the chart. They represent the worst falls we've ever seen. This is where we are right now, and this is how far it could still go. The funny part is, we saw worse just a few years ago, when the pandemic just began, but things bounced back up so fast that we've already forgotten about it. But all this just goes to show that market volatility isn't a new thing. The stock market has always been risky. Those high returns you were enjoying, they come precisely because of risk. If stocks weren't risky, everyone would buy them, pushing prices up until returns matched government bonds. You see, it's the risk that creates the opportunity for return. Here's a fact that might help convince you further. The stock market spends roughly 90% of its time below its previous peak. That's right, being in a drawdown is the normal state. Even in years when the market ultimately goes up, you're practically guaranteed to see at least one 10% drop along the way. In the 45 years of Sensex data we have, the average annual drawdown was 20%. This isn't unusual, it's just how the markets work. Now you might look at all this and think to yourself, all I need to do is time the market right. Well, hindsight makes everyone a genius, but nobody, and I mean nobody, consistently times market tops and bottoms. Even if you had perfect foresight about tomorrow's news, you'd likely still struggle. In one famous study, students were given the next day's newspaper much before it went out to everyone else. In other words, they had access to foresight that no one else had, and yet these students still only guessed the market direction correctly just 51.5% of the time. Timing the market isn't just hard, it's nearly impossible. So now what? 1. You found out that bear markets are inevitable and in fact a feature of the market. 2. For all you know, the current drawdown hasn't even bottomed out yet. And 3. Neither can you time the market, nor can you game the market by avoiding risk altogether. So what can you actually do to manage risk? First, understand this fundamental truth. Many investors have this fantasy that with the right strategy, they can somehow get high returns with little risk. This is simply not possible. Every risk reduction measure comes with a cost, usually in the form of lower returns. But there's still something that can be done. There are 3 primary ways to manage risk in a bear market. 1. Asset allocation. This is about how much of each asset class you own. Your allocation should reflect your goals, time horizon, and most importantly, your ability to sleep at night during market turbulence. Which brings us to point number 2, emotional discipline. This is the hardest but most important aspect. Can you stay invested when every instinct is screaming at you to sell? Can you resist checking your portfolio every hour? Can you avoid the financial news when it's all doom and gloom? Because the bear market can be a scary place that will test your resolve. Point 3. Diversification. Don't put all your eggs in one basket. or even in one asset class. Spread your investments across different types of assets that don't move in perfect sync with each other. Now, there are countless strategies you can use to allocate your assets and diversify your portfolio. You have mean variance optimization, capital asset pricing, risk parity, tactical asset allocation, goals-based investing, and life cycle approaches. Wall Street loves to make diversification sound complicated. But here's the secret. Even simple diversification works remarkably well. Just take a look at this. These are the annual returns for the three most common asset classes: equities, gold, and government bonds. Now, what this chart fundamentally tells you is that equities are really volatile. Just look at the range of these returns, and that asset classes, even safe ones, can go through long periods of underperformance. Look at gold returns from 2013 to 2018. That would have been painful, right? But pay attention to the last column. This shows returns from an equal weight portfolio: 33% in equity, 33% in bonds, and 33% in gold. It's so basic, you'd laugh if an investment advisor suggested it. But the returns, as you can see, are pretty solid. And more importantly, the worst years aren't nearly as bad as an all-equity portfolio. Now, is this the best way to allocate assets? Well, define best. The best portfolio depends entirely on what happens in the markets, and that can only be known in hindsight. Now, the point here is that even simple rules of thumb can work well. Your job isn't to find the perfect portfolio. It's to find one good enough that you'll actually stick with through good times and bad. You see, investing is actually quite simple. In fact, it's very simple. But just because it's simple doesn't mean it's easy. The principles are straightforward. Buy low-cost, diversified funds, invest regularly regardless of market conditions, diversify across asset classes, stay invested for the long term, ignore the noise, don't try to time the market, and that's it. That's the secret formula. But executing this simple plan through market turbulence, that's the hard part. As Jack Bogle put it, the secret to investing is that there is no secret. It's about elementary arithmetic and fundamental principles. But it requires discipline, patience, steadfastness, and that most uncommon of all gifts: common sense. The path to investing success isn't finding some magical strategy that avoids all downturns. It's having the emotional fortitude to stick with simple principles when markets get scary. Remember this: if you're young, a bear market is actually a gift. But why? Because you're buying shares at discounted prices. Your future expected returns are higher after a market fall. The real question then isn't whether markets will fall. They always do eventually. The question is, are you prepared for when they do fall? And more importantly, do you have the courage to hold when others are fleeing? Because that's how wealth is built, not by timing the market, but by time in the market. If you found this video helpful, hit that subscribe button and share this video with someone who's panicking about their portfolio. And remember, the best investing advice often comes during the worst market conditions. Until next time, and keep investing wisely.